Good morning, everyone. It is always fun to do these sort of bull-bear things, to give you a contrast on how people look at the world. So I'm Zach Pandl. I have the great pleasure of overseeing the research function at Grayscale. Grayscale is the world's leading crypto investment manager. Prior to this life, I did 20 years as a macroeconomist and market strategist on Wall Street. And I think what I'm going to talk to you about is sort of as an economist or from a macro standpoint, why crypto seems obvious to me. Why this feels like if I'm going to work for another 15 years or whatever, then this is what I want to be spending all my time and all my energy and all my capital on, is this asset class. And it has a lot to do with how I see the world today. So I thought all of those points in the last presentation were good and interesting. I maybe take a step back and think, how does the macro picture look today, and what the heck does that have to do with crypto? So here are the kind of key things that stand out to me. If I can get the clicker going. Can I get there we go. Okay. So the first thing is that assets are very expensive. This is the multiple on the S&P 500 going back to 1880. As you all know, we are trading at very high levels. And the numbers are just sort of bonkers if you think about it. I have a 17-year-old daughter who was born in 2009 when the index was 700. She is, now a junior in high school, and the index is 7,000. So the S&P 500 has 10x'd over that time. It's been printing a 15% annualized return, roughly double what the historical average is. And not all of that is earnings. It's also multiple expansion. So we've had an incredible run for stocks for almost 2 decades. And now we are sitting at levels where the valuation of the index is very high. So we need to think about, where is the growth going to come from in the future? What are we going to do with our portfolios now that the great run in U.S. large cap equities is something in the rearview mirror? Can it be reproduced? The same thing goes for other assets like real estate. This is another way to look at kind of long-term valuations. The equivalent in real estate to a PE ratio, price to earnings ratio, is a price to rent ratio. You also see U.S. real estate trading at historic highs, basically at the highs that you were in the housing bubble. Last time it was more of a credit-fueled thing, as you know, prior to the 2008-9 recession. This time it's been more of a real economy shift. COVID hit the economy. People moved out of city centers into suburbia, driving up the value of houses. But the kind of key message is that conventional assets like stocks, like real estate, are very highly valued. Okay, so that's the first challenge for investors. Given that fact, where are we going to go for returns? Or do we have enough growth to continue to see those types of returns? And to me, these are difficult questions. And I'm sort of skeptical that we're going to see enough growth in the economy to continue to produce compelling returns. And there's different stories to tell, but the simplest one is just a demographic challenge. The number one reason that the earnings grow, that there's new demand for real estate, is population growth. That's the first step for a growing economy, is some kind of population growth. And we have a demographic problem in lots of different parts in the world. The size of the population is already shrinking in both China and Europe. And we know that that is having an effect on financial assets and real estate assets in both of those places. When you look at the world as a whole, there is still some population growth, but most of it is coming from Africa. In those assets, there's probably going to be some interesting investment opportunities in Africa over the coming decades. But of course, the risk profile of those assets is quite a bit different than in developed markets or even in China. So you're going to have maybe some return, but a different kind of risk profile. In the U.S., we still have some population growth, sort of. There is some tendency for the population to grow, but as all of us know in this room, we've had a kind of sudden stop in immigration policy. And I'm not going to kind of dwell on that controversial American political issue, but strictly from a macroeconomic standpoint, less immigration means less demand for real estate, less consumers, less people paying sales taxes, all these kinds. It's negative for short-term U.S. economic growth. So one challenge for finding returns is just that, population growth is in a more challenging place than it has been really since all of our lifetimes. All of us have been investing in a period where population growth has been moving in a favorable direction for asset returns. Now we live in a different type of world. One thing that we have no shortage of, though, is debt and deficits. This chart shows U.S. federal government debt as a share of GDP since the founding of the nation. We are running a debt to GDP ratio of about 100%. This is similar to the final years of World War II. only unlike that time, there is no prospect to demobilize the military to get this thing under the control. It's just going to continue to be a straight upward line. And this is not a Trump thing or a Biden thing. This is a bipartisan thing. And the math is extremely easy to understand. Every year, for all the Americans in the room, maybe some international visitors, but for all the Americans in the room, we pay in taxes to the federal government 17% of GDP. That's how much tax collection there is from all the different sources, income taxes, tariffs, whatever, 17% of GDP. And every year we send out the door exactly the same amount, 17% of GDP, in only two things: interest payments and entitlement spending. That's it. There's no money left over for anything else, including national defense, roads and bridges, or scientific advance, anything else. All of our tax revenue is taken up on interest payments and entitlement spending. And so unless we have a kind of political will to significantly raise taxes and or significantly cut entitlement spending, we're going to continue to see this number going up. And I think it's impossible, really, as an American political observer, to see something like that happening. There is no political will to deal with anything like that. And frankly, President Trump is pretty explicit and pretty honest about the electoral dynamics about this issue. Now, what does this have to do with assets? So the first kind of implication, it has to do with currency risk and inflation risk and currency debasement. So conceptually, we have an independent central bank, the Federal Reserve, that is supposed to manage monetary policy to achieve a 2% inflation over time, and they're supposed to ignore fiscal policy issues. In practice, though, it's hard to draw such a sharp distinction between a government that's running excessive debts and inflation management. And the reason is that these things are mechanically connected, of course. When the central bank raises interest rates, say to control inflation, it also raises the interest expense for the Treasury and causes headaches for elected officials. When politicians are going out gathering votes, they don't say to their constituents, hey, you should vote for me because I promise to carefully pay back the debt that the last guy accumulated. They get votes by saying, I'm going to cut your taxes, or I'm going to build a bridge somewhere. And so when interest expense is eating up more and more of federal government resources, it creates political economy problems for the central bank. Politicians essentially complain to the Federal Reserve and try to pressure them into managing monetary policy in a way that helps with the debt issue. So this is what kind of currency debasement is all about, that you can't manage monetary policy to an objective of very low inflation, kind of tight or hawkish monetary policy over time if you run a large debt stock, because it creates interest expense for the Treasury. And that's what we see around the world in history when these types of things happen, and I believe is sort of what we are seeing in a toing and froing sort of sense in the U.S. Today. Now, in the last couple of months, there's been some things that have shored up the Federal Reserve's independence a bit. Trump seems to be losing a case at the Supreme Court. He didn't get maybe his first choice Fed chair. Jay Powell is going to stick around for a little while. So, potentially this is shored up over the short term. But this issue is not going anywhere. This is going to be a many decades long challenge for the United States, and it is driving interest in alternative stores of value, alternative ways to park our assets beyond U.S. denominated assets. Wrong way. Okay, so lots of different countries have this issue, a problem of deficit spending and high debt growth, but these issues are compounded when they happen in the United States because of the role of the dollar in the international currency system. Most currencies around the world are not freely floating. They're anchored to some other currency in some way. And today, about half of all currencies, half of all the currencies of all the countries around the world are anchored to the U.S. dollar. And this creates a set of interdependencies between the U.S. and those countries. These countries need high-quality U.S. dollar-denominated assets in order to defend this structure, to make sure that they can manage their currency in this type of way. And the U.S. knows that countries need those assets, and so we can get away with issuing more debt, running deficits for a longer period of time without paying a market penalty in terms of high interest rates. But there is increasing pressure on this system. Part of it is just from the debt growth itself. Countries are becoming skeptical that we can manage low and stable inflation and seeing the political economy threats to the independence to the Federal Reserve. It's also coming under pressure because of sanctions. Countries want to hold these assets, but if they need to use them in a pinch, and then the U.S. Sanctions that country, prevents them from using it, like we did with the Russian central bank. It, of course, will discourage countries from holding U.S. assets in this way, and they'll begin to look at alternatives. And lastly, it's coming under pressure from geopolitical change. All the Gulf currencies are pegged to the dollar, for example. Is this going to stand the test of time as we see military conflict in that region, as these places are transitioning away from an oil-dependent economy? The Hong Kong dollar is pegged, of course, to the U.S. dollar. Hong Kong is China's primary financial center, and it does not have the yuan. It has the Hong Kong dollar, and the Hong Kong dollar is pegged to the U.S. dollar. How long will that system last with the U.S. and China going through this sort of slow-motion economic divorce? So most of our assets are in U.S. dollar-denominated stocks, bonds, real estate. Those assets are highly valued, and the currency that they are denominated in is coming under pressure from debt growth, from geopolitical change that may damage the U.S. dollar's role in the world and lead to currency depreciation over time. Is there a way out? Well, I think the kind of optimistic take is that the way out is some kind of AI productivity miracle. And I would agree that this conceptually is the thing we should pray for. Get down on your knees every night and pray for an AI productivity miracle, because it will solve all your portfolio problems. If we have an exceptionally strong phase of AI growth, a kind of second industrial revolution from AI, it will solve these problems. It will make it easier to control the debt stock, and will mean that the demographic challenges and the high valued equities are not such a big problem. And it probably will shore up the value of the U.S. dollar, because the U.S. is clearly a leader in AI. But I guess I'm not so sure, and I have this chart in the back of my head from a kind of macro guy's standpoint when thinking about this. This is U.S. real per capita GDP since the founding of the country. And you can see that this line begins to hook up in the middle of the 19th century. That is a phase that we now look back and we call the Industrial Revolution, okay? The Industrial Revolution was a series of advances that moved us from this agrarian society that lasts for hundreds of years to something that is essentially the miracle of modern society, that we have continued gains in the standard level of well-being for people around the world every single year. So it's a kind of miracle of modern growth. But the other fascinating thing about productivity and innovation is that since that time, the gains have been amazingly linear. So since the 1850s or 1870s, however you want to mark it, we have seen almost exactly 2% real per capita GDP growth in the U.S., despite lots of different things happening. A lot of things have happened in that 175-year period. Electrification, the internal combustion engine, the Wright brothers, computers, the internet, okay? All of these things have allowed us to continue on this path of ever-increasing productivity at about a 2% annual rate, but they have not led us to see an acceleration. My working assumption is that's what we will see from AI. It's another amazing advance along the lines of electricity and flight and the computer. These are amazing advances, and they will probably allow us to continue on this path. But as long as they are only that good, as long as the productivity gain is only that good, then our portfolios are going to be left with some of these macro challenges. We are going to have problems of highly valued assets, debt growth, structural pressures on the dollar, etc. Okay, that brings me to crypto. This is how I think about crypto in this context. We have a kind of modern macro picture that involves expensive assets. We need a lot more growth to justify the value of these assets, but we have things like demographic headwinds, we have debt to debasement spirals, we have a fragile currency order, and maybe we have a kind of hope of an AI productivity miracle as the best chance for our portfolios to just naturally keep producing strong returns. People say a lot of things about crypto, obviously, not all positive things. But how I think about it is this, that you have a new type of financial technology, the public blockchain, and it's being driven by its own adoption trends. And this thing is at its mainstream moment. We are over the gates now. From a technological standpoint, from a regulatory standpoint, there is no going back. There is no stopping this technology from deepening its integration with the global financial system. It's something that provides us digital scarcity, and scarcity is something that we have a need for in portfolios because of debasement risk. It's hard to find sources of scarcity, especially when gold has run so much, when real estate has run so much. How are we going to build scarcity into portfolios? Crypto is something that is global and grassroots. It's not being imposed by any one institution. There's an environment where institutions are losing trust. This is an asset and a technology that is a bottoms-up, grassroots phenomenon taking on a life of its own. And finally, it's complementary to AI. Maybe we will have an AI productivity miracle. I'm a little bit skeptical, but maybe we will. This is a piece of technology that should benefit from growth in AI. It's not in conflict with growth in AI. So the Grayscale process, well, that's how we think about this. Is a very zoomed out level. The Grayscale process is to help investors navigate their way around crypto. We use a framework called crypto sectors. This is like the GIC system in public equities, divide equities up into market segments like energy, consumer staples, industrials, et cetera, et cetera. We divide the crypto asset class up into 6 distinct sectors and help investors navigate what is going on in these things. What are all the uses of public blockchain technology? How do they drive value to these individual assets? And this includes things like Bitcoin or Zcash, of course, that don't involve yield or stake, but other assets like Ethereum and Solana and many of the proof of stake networks that can produce a native staking reward. Okay. That's what I wanted to get across today. For me, crypto is a no-brainer. After quitting my job a number of years ago to do this full-time, I have never looked back. I think there is no better way for me to be kind of spending my time and energy across capital markets than on this asset class, and look forward to sharing any of those ideas in the future with all of you. Thank you for listening.